Welcome back to your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the economy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.62, which is a good bit down. I want to say last week's was 6.73, and it looks like rates are finally coming down. I believe that we are close to where we were back in April. So that is good news. Rates are coming down. All right, it has been a pretty big week already economically, and we are going to take a look at what is coming up for the Thursday and Friday session. So let's get on over to the charts. Now we are looking at the U.S. 10-year. Like I said, the rates are coming down. So we see, let's see, this was back May 22nd, and we see spikes come down, spikes. And as you notice, every time since May, there's been this spike. It's really been coming down less and less. So these highs are getting lower. So it's lower highs as we go down. And now this is interesting because the U.S. 10-year isn't necessarily showing it, and this could just be a discrepancy between the 10-year and how rates are priced. Usually they're 1.5% to 2% different, I believe, and that is the spread that investors want to make, or not investors, but lenders make whenever they are selling these mortgages. But yeah, like I said, the 30-year fix, which we can go take a look at that now. So 30-year fix, 6.63 as of August 7th, and July 31st it was 6.72. And last time we were close to this area was April 10th. So let's compare this. Let's see, April 10th. Where was that? Oh. Okay. Maybe there's not a discrepancy. So it is pretty similar. It looks like back, like April 4th would have been a really solid day. But let's see. I don't think that we had, no, because the way that this goes. So, yeah, April 4th was like the day where it dipped down like crazy, but then also jumped back up. So that's the U.S. 10-year. Yeah, things are looking good. And also, this is out of order, but when we look at the September Fed meeting, there is a 93% chance now for an interest rate cut. And I'll explain why, but this is pretty solid news. So when the Fed cuts rates, this does not mean that they're cutting mortgage rates. However, it indirectly will, well, more than likely will cut mortgage rates. So just as a reminder, the Feds are not meeting to cut mortgage rates. They are cutting the federal funds rate. Okay? Now, the reason for this is on Tuesday when we look at the CPI, which is the Consumer Price Index right here. This is one way to measure inflation. The Fed prefers to use the PCE, I believe, but the CPI is also really good to look at. And then Thursday we have PPI, which is just the producer side of things. So this is more manufacturers, this is more consumers. When we look at where inflation is, inflation actually came down a little bit month over month. When you look at, not inflation, CPI came down month over month when you look at non-core. And then for core, it was up a little bit, but that was what was expected. So inflation really isn't running rampant. You know, it's not going crazy right now. We will see with PPI though, and then whenever the PCE data comes out, that'll be pretty important. But yeah, I mean this CPI read is really good, and it really benefited the U.S. stock market and the bond market. We can actually, let's see if we look. That was Tuesday. Yeah, Tuesday, I mean, it wasn't like a crazy jump, but let's look at the bond market. Yeah, the bond market really kind of like had been rallying since, let's see, I mean, really since July 16th up until August 5th. Let's see. And then bonds kind of came down. Okay. So bonds, they came down a little bit, which made the 10-year jump up a little bit. But um, I think that the cutting of the rates will really be beneficial for mortgage rates. But we will see. We will see what happens. So, yeah. And then, like I said, we have PPI Thursday at 8:30 a.m. And then we have, this is pretty interesting to look at mortgage delinquencies. I saw a statistic the other day, and, it's the internet, so always got to source those things out. But it was showing that student loan debt is just, through the roof, the highest it's ever been. So, looking at student loan debt is definitely different than mortgage delinquencies. But if we see a pattern of delinquencies in credit, obviously that's really, really terrible. So it's, this is definitely something to keep an eye on. Also, looking at retail sales, something to keep an eye on. And then we have the preliminary University of Michigan consumer sentiment Friday. All right. We already looked at that. And yeah, I mean, that's about all that we have for you. If anyone has any mortgage questions, reach out to us at 877-TEAM-MBL or visit us at www.mortgagesbylinda.com. And we'll check back in with you next week. Have a good one. Bye.